Friends, thank you for being here today. What if I told you that the metal powering your phone, your car, and the entire global green energy transition is quietly disappearing from the open market? Not because we ran out of it in the ground, but because the world dominant processor has decided to close the gates. And when you look at the recent volatility in silver prices, the explosion to over $64, followed by a brutal crash, do you see a market functioning normally? Or do you see the violent tremors of a system that is breaking apart under the weight of physical reality? To understand what is happening right now, we have to strip away the noise of daily price charts and look at the tectonic shifts occurring beneath the surface. We are witnessing a fundamental paradigm shift in the global silver market. For decades, the world has operated on the assumption of abundance, the belief that silver, like many other commodities, is cheap, easy to source, and always available if you are willing to pay the market price. But that era is ending. We are moving rapidly into a new reality of scarcity and control, where silver is no longer just a precious metal or a speculative financial asset. It has been redefined as a critical strategic material, essential for energy security, technological dominance, and national defense. And the catalyst for this shift is not a mine collapse or a labor strike. It is a deliberate policy decision by China, the world's largest industrial consumer and refiner of silver, to tighten its grip on global supply. This is not a drill, and it is not speculation. It is a documented, verifiable shift in geopolitical strategy that parallels the weaponization of supply chains we have already seen in rare earth elements, gallium and graphite. The signal has been sent, and the consequences for the global economy, for the green energy transition, and for every investor holding, or thinking of holding silver, will be profound. Now, to understand the mechanics of this shift, we must look closely at the specific policy directive that marks the end of easy access. The specific mechanism driving this change is a policy directive known as Ministry of Commerce Document 68, announced on October 30th, 2025, and taking full effect in January 2026. This document is not merely an administrative update, it is a strategic gatekeeping mechanism. Document 68 implements a rigorous system of export restrictions that fundamentally alters how silver leaves China. On paper, Beijing frames these restrictions as measures for environmental protection and high-quality industrial development. However, the mechanics of the restriction tell a different story, one of consolidation and exclusion. Under the new rules, silver exporters must meet exceedingly high production thresholds. An exporter must demonstrate a minimum of 80 tons of refined output for the year 2024, with a slightly lower threshold of 40 tons for those in Western provinces. Furthermore, companies are now required to possess specific certifications, including ISO 9000 and ISO 14000, and must have a demonstrated export performance record spanning from 2022 to 2024. Crucially, export rights are now limited exclusively to firms that appear on an official approved list. If a company is not on the list, it cannot export refined silver. This is a classic method of state-directed consolidation. By raising the barriers to entry, the state effectively cuts off the long tail of smaller independent suppliers that fueled the global spot market, funneling all export activity through a handful of large state-aligned entities. The immediate impact of this policy cannot be overstated. Analysts estimate that these restrictions could impact anywhere from 60% to 70% of the global silver supply flows that have historically passed through Chinese processing infrastructure. China is a massive hub for refining. Silver mined in South America or Mexico often ends up in China for processing before entering the global supply chain as high-purity industrial bullion. By tightening the tap at this specific choke point, China gains leverage over the entire downstream market. Even a conservative reduction in exports, say by just 50%, would create a global annual deficit exceeding 5,000 metric tons. The strategic intent here is clear. China produces approximately 90% of the world's solar panels. It is a dominant player in electric vehicle battery manufacturing and advanced electronics. All of these industries are voracious consumers of silver. By restricting exports, Beijing ensures that its domestic champions have priority access to refined silver at stable prices, insulating them from global volatility while simultaneously forcing international competitors to scramble for increasingly scarce material outside the Chinese wall. It is a policy of China first, applied to the raw ingredients of the 21st century economy. However, policy is only one side of the coin. We are also facing a structural supply crisis that explains why the market is trapped. A skeptic might ask, if China restricts exports, won't the rest of the world just mine more silver? This question assumes that silver supply is elastic, that it responds quickly to price signals. Unfortunately, the geology and economics of silver mining make this impossible in the short to medium term. The market is facing a structural rigidity that price alone cannot fix. The primary constraint is the byproduct reality. Approximately 72% of the world annual silver supply is not mined from primary silver mines. Instead, it comes out of the ground as a secondary byproduct of lead, zinc, copper, and gold mining. This economic quirk has massive implications for supply elasticity. When a mining company operates a massive copper mine, their production decisions are driven by the price of copper, not silver. If the global economy slows down and demand for copper or zinc falls, the mine will reduce output. As a result, the production of silver from that mine drops automatically, even if silver prices are skyrocketing. Silver supply is essentially held hostage by the dynamics of other base metals. Furthermore, global mine supply has been remarkably stagnant. Despite silver prices doubling in recent years, annual global mine production has remained flat at around 813 million ounces since 2016. There has been no surge in output because the low-hanging fruit has already been picked. Ore grades are declining globally, meaning miners have to dig up more rock to get the same amount of metal. Even if investors threw billions of dollars at the sector today to build new primary silver mines, the timeline for relief is measured in decades, not months. The average lead time from the discovery of a deposit to the first pour of silver is now 7 to 15 years. This delay is caused by an increasingly complex web of permitting requirements, environmental impact studies, financing hurdles, and community opposition. In Western jurisdictions specifically, opening a new mine is a bureaucratic marathon. Therefore, the idea that a supply response will arrive in time to offset the shock of China export restrictions in 2026 is a fantasy. The supply we have today is the supply we will have for the foreseeable future. But now, a significant portion of it is being ring-fenced behind Chinese export controls. While supply remains locked in a geological and regulatory straitjacket, we are simultaneously witnessing an industrial juggernaut of exploding demand. This demand is driven by three distinct and accelerating industrial revolutions: solar photovoltaics, PV, electric vehicles, EVs, and the AI data center boom. The solar industry has become the single largest industrial consumer of silver. In 2025 alone, solar panel manufacturing consumed approximately 261 million ounces of silver. To put that in perspective, that is nearly 1/3 of global mine supply vanishing into a single industry. And crucially, this is destructive demand. When silver is pasted onto a solar wafer, it stays there for the 25 to 30-year life of the panel. At current prices and technologies, it is rarely economically viable to recycle that silver. It is effectively removed from the global stockpile forever. Simultaneously, the automotive sector is undergoing a massive electrification shift. Electric vehicles are silver-intensive machines. While a traditional internal combustion engine car uses a modest amount of silver, an EV uses 67% to 79% more, typically 25 to 50 grams per vehicle, for battery management systems, extensive cabling, and electronic controls. With global projections estimating 20 million EV sales in 2025, that equates to another 85 to 90 million ounces of silver demand. Like solar, this metal is locked away in the vehicle for a decade or more. Perhaps the most aggressive new entrant to the demand side is the digital infrastructure sector. The exponential growth of artificial intelligence requires massive data centers, and the rollout of 5G networks requires millions of new base stations. Every server farm, every high-speed switch, and every 5G tower relies on silver for its unrivaled electrical conductivity. You cannot build the architecture of the digital age without the most conductive metal on the periodic table. Unlike investment demand, which can be fickle and sentiment-driven, this industrial demand is sticky. A solar panel manufacturer cannot simply decide not to buy silver because the price went up. They have factory quotas to meet and contracts to fulfill. They must buy regardless of price. This turns the silver market from a discretionary investment market into a desperate procurement market, where industrial users are forced to compete with investors for the same shrinking pool of available bars. This collision of rigid supply and soaring demand has decimated global inventories, creating a dangerous inventory paradox that confuses many casual observers. If you look at the COMEX warehouses in the United States, you might see a headline number of approximately 126 million ounces and assume the market is healthy. But this is a mirage that hides a much more critical shortage in the physical trading hubs that actually matter for global flows. The real stress is visible in the London Bullion Market Association, LBMA, and the Shanghai Futures Exchange. In London, which is the heart of the global physical silver trade, inventories are critically low. Analysts at TD Securities have estimated that the free-floating stockpile in London, the silver that is actually available to be bought and sold, rather than being held in ETFs or allocated to long-term owners, has shrunk to just 135 million ounces. To give you a sense of how precarious that is, 135 million ounces is roughly half of the daily trading volume of the paper silver markets. The buffer is gone. In Shanghai, the situation is even more acute. Inventories at the Shanghai Futures Exchange have hit near-decade lows, hovering around 780 tons. This depletion was exacerbated in late 2025 when China actually exported a record amount of silver to help ease a massive squeeze in London. They drained their domestic reserves to keep the global system functioning, but that valve has now been shut. The drain on above-ground inventories over the last decade has been persistent and structural. We have been eating into our savings to pay for our consumption, and the savings account is now flashing red. I want to pause here and hear from you. Do you think the global market is prepared to handle a supply shock of this magnitude? Or are we sleepwalking into a crisis? Let me know your thoughts in the comments below. These physical realities are now manifesting in financial market signals, specifically through the price of volatility. The financial markets are beginning to price in this new reality, manifesting an extreme volatility that punishes both complacent bulls and leveraged bears. In December 2025, we saw a perfect example of this instability. Silver prices spiked to an all-time high of $64.65 per ounce, smashing through records that had stood for 45 years. It was a moment of euphoria for long-term holders, but then, within hours, the price crashed 3%, forming a bearish engulfing candle on the charts, a classic technical reversal signal. This volatility is being driven by a tug-of-war between the physical reality of shortage and the macroeconomic maneuvers of central banks. The Federal Reserve, pivoting to a more hawkish stance with signals of only one rate cut for 2026, strengthened the dollar, which traditionally hurts precious metals. This macroeconomic headwind collided with the physical tailwind, creating a violent churn. But if you look past the headline price, the hidden stress indicators are screaming. The lease rates for silver, the interest rate one must pay to borrow physical metal, have gone haywire. In a normal market, lease rates are practically zero. Recently, one-month lease rates spiked to annualized levels of 14% to 24%, with a terrifying peak of 34.9% in October. When banks and industrial users are willing to pay credit card-level interest rates just to get their hands on physical bars for a month, it tells you there is a desperate, acute shortage of metal availability. Furthermore, the market is in backwardation. This is a rare anomaly where the spot price of silver, the price to get it right now, is trading significantly higher than the futures price, the price to get it next month. For instance, with spot at $51.40 and futures at $48.56, the market is screaming that it values immediate possession far more than a promise of future delivery. This is the ultimate signal of physical tightness. Adding to the fire are the exchange-traded funds, ETFs, like SLV. In November alone, SLV saw inflows of 15.7 million ounces. Every time an investor buys shares in these trusts, physical bars are theoretically moved into a vault and locked away, removing them from the pool available for Apple, Tesla, or Samsung. The investment sector is effectively hoarding the inventory that the industrial sector desperately needs. Ultimately, this brings us to the geopolitical ramifications and the weaponization of access. The United States and Europe have committed themselves to grand strategic goals: the Green New Deal, the modernization of power grids, and the expansion of defense capabilities. All of these ambitions are silver-intensive, yet the West has allowed itself to fall into a trap of dependency. We may have mines in the Americas, but we lack the refining capacity and the integrated supply chains to process that silver at scale. We rely on the Chinese infrastructure to refine the very metal we need to compete with them. By tightening exports, China is not just protecting its environment, it is exercising geopolitical leverage. It is a soft power chokehold. If Chinese export volumes drop as predicted, Western manufacturers will face delivery delays, higher premiums, and supply uncertainty. This phenomenon will manifest as greenflation, spiraling costs for green energy projects. Solar farms will become more expensive to build. EVs will become more expensive to produce. This economic pressure could force Western governments into difficult policy reversals or necessitate massive inflationary subsidies to keep their energy transitions on track. The world is fragmenting. We are entering an era of resource nationalism where trade is governed by security and resilience, not efficiency and cost. The just-in-time delivery model, which prioritized keeping zero inventory to save money, is dead. In a world of export controls and strategic competition, just-in-case inventory is the only safe way to operate. Industrial buyers must now hoard inventory or secure long-term contracts, further draining the liquidity of the spot market. This geopolitical fragmentation brings us to perhaps the most critical, yet least understood aspect of this crisis, the inevitable decoupling of Western paper markets from Eastern physical reality. For decades, the price of silver has been discovered in New York and London, largely through the trading of futures contracts and unallocated accounts. Essentially, paper promises of silver that exceed the actual physical metal available by huge multiples. The system worked seamlessly as long as silver was abundant, and investors were content to hold paper claims rather than demanding delivery of the metal itself. But China's move to restrict exports fundamentally breaks this mechanism, exposing the fragility of a market built on leverage rather than logistics. Consider the flow of physical metal versus the flow of digital contracts. While Western hedge funds trade digital contracts based on algorithmically driven technical signals, effectively shuffling paper back and forth, physical silver has been relentlessly migrating from west to east. We are witnessing a historic drainage of vaults in London and New York to satisfy the insatiable industrial appetite of Shanghai, Mumbai, and Shenzhen. When China tightens exports, it effectively creates a closed loop for its domestic supply, trapping that metal within its own industrial ecosystem. This leaves the Western paper markets floating on a shrinking foundation of physical inventory. The danger here is a short squeeze of systemic proportions, not just a squeeze on price, but a squeeze on deliverability. We must also confront the specific mechanics of how this breaks the investor portfolio. In a true shortage, the divergence between the spot price flashed on a trading screen. Furthermore, this is not just a China story. It is a contagion of realization. As Beijing secures its resources, other nations are watching and calculating their own vulnerabilities. We are likely to see a domino effect of resource nationalism. Countries like Mexico and Peru, which are major primary producers, may look at the strategic value of their own reserves and question why they are exporting raw wealth for depreciating fiat currency. If these nations begin to implement even soft resource nationalism, higher royalties, export quotas, or domestic reserve requirements, the global supply chain does not just tighten, it snaps. The era of the globalized, frictionless commodity market is being replaced by a fragmented landscape of strategic hoarding, where possession of the asset is the only metric that matters. This leads to a final, uncomfortable realization for the Western investor regarding the power of central banks. We have been conditioned to believe that central banks can fix any crisis with liquidity. They can print dollars, euros, and yen to bail out a liquidity crisis in the bond market or to prop up equity valuations. They can inject trillions of digits into the banking system to keep the wheels turning. But there is one thing they cannot do. They cannot print an ounce of silver. They cannot quantitative ease a solar panel into existence. When a physical shortage meets a printed currency, the adjustment is not linear, it is exponential. The mechanism of price suppression through paper derivatives fails when the physical collateral is gone. We are standing at the edge of that failure point, where the illusion of infinite paper supply crashes into the hard wall of finite physical reality. So, what does this all mean as we stand on the precipice of 2026? It means the wolf is at the door. The silver market is signaling a structural break from the past. While short-term technical trading and Federal Reserve policy may force corrections, perhaps pushing silver back down to the $50 or $55 range temporarily, the long-term floor is rising beneath our feet. The cheap silver of the past is gone. The warning signs are flashing in the lease rates, in the backwardation, and in the sheer desperation of the policy moves coming out of Beijing. This is not about running out of silver in the earth crust. It is about a bottleneck in refining, a depletion of available stockpiles, and a deliberate closing of the gates by the dominant player. The wolf is no longer a fairy tale used to scare investors. The supply crisis is real. The industrial demand is structural and unyielding, and the geopolitical conflict over resources is just beginning. The systems built on the assumptions of abundant, cheap silver are being dismantled, and we are entering a period of high volatility and inevitable repricing. For those watching the markets, the question is no longer if a shortage will occur, but how violent the adjustment will be when the rest of the world finally realizes that the metal they need is no longer for sale. If you found this analysis valuable, please hit that like button and subscribe to the channel so you do not miss our future updates on this unfolding situation. Friends, the signal has been sent. The shortage is here. The only question left is, are you listening?